Would you like to own a slice of one of the best businesses on the planet? Looking for a world-class compounder that is making its shareholders rich? Like the idea of getting a stock on sale after a 30% drop in price? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fever has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is one of the world's leading technology conglomerates. Technology is radically changing our lives. Technology is what's allowing me to make this video for you, and it's what's allowing you to watch this video. There is no future that I can imagine in which we're all using less technology. Well, this is one of the biggest and best tech companies on the planet. It's poised to capture a lion's share of growth across tech, and it's poised to continue growing its revenue, profit, and dividend at sky-high rates. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explain exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Microsoft Corporation, which appear to be trading at a significant discount today. Microsoft Corporation, stock ticker MSFT, is a global technology company that provides a range of hardware and software products and services. Founded in 1975, Microsoft is now a $1.8 trillion by market cap technology gargantuan that employs 220,000 people. Fiscal year 2022 revenue can be broken down across the following three business segments: intelligent cloud, 38%, productivity and business processes, 32%, and more personal computing, 30%. Some of the company's primary products and services include Windows operating software, Azure Intelligent Cloud, Office software, the Xbox gaming system, LinkedIn, and Surface computers and tablets. I like to invest in what I call sure things, and I can think of fewer things that are more sure than our future society becoming increasingly reliant on technology. Conversely, I find it impossible to imagine a future in which human beings are using less technology. As one of the world's largest technology companies, Microsoft is set to capture a lion's share of all of this. But it's not just scale that sets Microsoft apart, it's also breadth. Whereas Microsoft was once mostly focused on software through their massively popular Windows OS, the company has transformed itself by broadening out into areas like enterprise solutions, networking, cloud computing, gaming, and even entire computer systems. But wait, there's more. Microsoft's breadth is increasing. Microsoft acquired ZeniMax Media, which is the parent company of game publisher Bethesda Softworks, for $7.5 billion, and the company's following that up with a planned acquisition of Activision Blizzard Inc., stock ticker ATVI, the maker of several major games such as the extremely popular Call of Duty series, for $68.7 billion. Microsoft is beefing up its content production power in an industry that has a very bright future. The gaming industry is now bigger than Hollywood. In addition, Microsoft has been turning itself into a serious player in the defense space. For example, Microsoft was recently awarded a share of a $9 billion cloud computing contract from the US Pentagon. Microsoft has incredible scale and breadth across areas of technology that are growing and becoming ever more important. This is why the company is almost a lock for higher revenue and profit and a growing dividend over the years to come. Already, Microsoft has increased its dividend for 20 consecutive years. The 10-year dividend growth rate of 12% is impressive. What might be even more impressive is the consistency of dividend growth. Microsoft has been pretty relentless over this period, with the dividend being raised at a 10% or higher clip in just about every year. On the other hand, what you sacrifice here is yield. The stock yields only 1.2%. Investors can take some solace in the fact that the stock has at times yielded less than 1%, this yield is now back to its own 5-year average. Still, this is really more of a long-term compounder than a current income producer, and with the payout ratio at just 29.3%, the dividend is positioned for more of that relentless double-digit growth. If you're a younger dividend growth investor who has time to let that compounding process play out, these metrics are very compelling. Looking at business growth, Microsoft has raised its revenue from $77.8 billion in fiscal year 2013 to $198.3 billion in fiscal year 2022. That's a compound annual growth rate of 11%. I typically look for a mid-single digit top-line growth rate from a mature business such as this. With a market cap of nearly $2 trillion, it's quite fair to say that this is a mature business. Despite that size, Microsoft has grown its top line at a brisk pace. That's extremely impressive. Meanwhile, earnings per share grew from $2.58 to $9.65 over this period, which is a compound annual growth rate of 15.8%. Just terrific. A combination of steady margin expansion and buybacks conspire to fuel excess bottom line growth. For perspective on the latter point, the company's outstanding share count has been reduced by approximately 11% over the last decade. Looking forward, CFRA is projecting that Microsoft will compound its earnings per share at an annual rate of 16% over the next 3 years. Basically, CFRA is assuming a continuation of the status quo. I see no reason to quibble with this. After all, Microsoft is in some ways actually becoming better as it gets bigger. That's a difficult and rare feat. There's the new defense deals, acquisitive growth in gaming, as well as the potential in AR/VR. CFRA highlights that last point, and I quote, "We note tremendous upside potential in AR/VR, both for gaming and a growing number of industrial use cases, well suited to Microsoft's HoloLens goggles and development platform," unquote. Meantime, the main cash cow of the company, cloud, remains a rock, showing 24% year-over-year revenue growth in the most recent quarterly report. The company's biggest segment is also its fastest growing segment, which is incredible. Microsoft Azure platform is estimated to have a solid number 2 share of the lucrative global cloud market, and this market is only getting bigger. Importantly, cloud isn't just a third-party enterprise thing. Its applications have moved internally, as CFRA notes, again, and I quote, "Revenue from cloud-based businesses also includes LinkedIn, Bing, and Xbox Live, and is now approximately 65% of total," unquote. I'm willing to accept CFRA's forecast as a base case here, which easily supports the expectation for low double-digit dividend growth over the foreseeable future. Simply put, it's a compounding machine that should keep compounding at a high rate. For growth-oriented dividend growth investors, this is about as good as it gets. Moving over to the balance sheet, Microsoft has a phenomenal financial position. The long-term debt-to-equity ratio is 0.3, while the interest coverage ratio is over 40. Furthermore, Microsoft has more than $100 billion in total cash, enough to pay off all long-term debt twice over. It's a fortress balance sheet. Indeed, Microsoft is one of only 2 U.S. companies with a AAA credit rating from Standard & Poor's, higher than the U.S. government, which can literally print money. Profitability is extremely robust. Over the last 5 years, the firm has average annual net margin of 29.7% and annual return on equity of 38.9%. Fundamentally speaking, this is one of the best businesses I've ever seen. And with global scale, switching costs, patents, R&D, and IP, the company does benefit from durable competitive advantages. Of course, there are risks to consider. Regulation, litigation, and competition are omnipresent risks in every industry. The very business model is a risk, as ever-changing technology introduces the risk of obsolescence. As broad as Microsoft is, the company missed the transition to mobile and now lacks a meaningful presence there. With a market cap of $1.8 trillion, Microsoft is staring down the law of large numbers. The planned acquisition of Activision Blizzard leads to risks around cost and execution. Saturation, especially in regard to Windows OS, is a downside risk to growth. Considering the immense quality of the enterprise, I see these risks as very acceptable. And with the stock down 30% from its 52-week high, the valuation makes the business especially appealing right now. The price-earnings ratio is sitting at 25.3. I think that's a perfectly reasonable earnings multiple for this growth profile, which puts the PEG ratio well below 2. Considering that the stock's own 5-year average price-earnings ratio is 36.9, this is not high. We aren't even close to that. This is a stock that often looks expensive, but it doesn't right now. There was a similar disconnect in the sales multiple, with the current price to sales ratio of 8.7 being much lower than its own 5-year average of 9.9. And the yield, as noted earlier, is right in line with its own 5-year average. I valued shares using a two-stage dividend discount model analysis. I factored in a 10% discount rate, a 15-year dividend growth rate of 12%, and a long-term dividend growth rate of 8%. The business is still in a state of high growth despite its massive market cap. I'm using a two-stage valuation model to account for this. Microsoft has been relentlessly consistent with low double-digit dividend growth, and CFRA is expecting the 15% plus compound annual growth rate for earnings per share to continue for the foreseeable future. With the low payout ratio and fortress balance sheet, I'm not sure why one wouldn't expect Microsoft to continue handing out approximately 12% dividend increases averaged out for the next decade or so. Now, that's a very high rate of growth to extrapolate out indefinitely. However, I do see this business as quite capable of high single-digit dividend growth over the long term. The dividend discount model analysis gives me a fair value of $239.73. The reason I use the dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates MSFT as a 4-star stock with a fair value estimate of $320. CFRA rates MSFT as a 5-star strong buy with a total target price of $330. I came out rather low, which is surprising. Perhaps I was too prudent. Averaging the three numbers out gives us a final valuation of $296.58, which would indicate the stock is possibly 26% undervalued. Here's the bottom line, guys. Microsoft Corporation is one of the best businesses I've ever seen, with quality radiating from every angle. As it's gotten bigger, it's actually gotten better. With double-digit dividend growth, 20 consecutive years of dividend increases, a very low payout ratio, and the potential that shares are 26% undervalued, long-term dividend growth investors looking for a world-class compounder would be wise to strongly consider buying shares in this very high-quality business. And now for a special news announcement. Johnson & Johnson, stock ticker J&J, just closed on its $16.6 billion acquisition of Biomed. This acquisition makes the world's largest healthcare conglomerate even bigger, accelerating growth in the medtech business. Johnson & Johnson was one of my top 5 dividend growth stocks for 2022. The fact that the stock's up in a massively down year for the market shows just how resilient Johnson & Johnson is. It continues to be one of my absolute favorite long-term ideas for dividend growth investors. Don't underestimate this one. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also, take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.